All right, let's talk about something huge. We're diving into the multi-billion-dollar world of cyber insurance, and there's a hidden risk, a flaw so big, one research paper is warning it could set off an economic shockwave even bigger than the 2008 financial crisis. Okay, so let's start with this quote because it really gets to the very heart of the problem. This idea that if you're measuring something the wrong way, you're absolutely going to manage it the wrong way, that's exactly what we're about to unpack. And there it is, the bombshell claim from the expert paper we're looking at today. We're not talking about a small miscalculation here. We're talking about a potential system-wide failure. I mean, the stakes just couldn't be any higher. So where did this all go wrong? Well, it all comes down to the industry grabbing a popular tool from the world of finance and trying to use it in a world it was never, ever built for. That tool is called value at risk, or VAR. And here's the simplest way to think about it. VAR basically tells you the minimum you can expect to lose on a really bad day. It's all about putting a floor on your potential losses, not telling you how high the ceiling could be. And this is where you can really see the massive disconnect. See, VAR was built for the world on the left, financial risks. They're kind of predictable, you have lots of data, and spreading your investments around usually helps. But cyber risk, that's a whole different animal. It is chaotic, everything is connected, and a single tiny vulnerability can cause a massive global domino effect.
So, why is using VAR in cyberspace so dangerous? Well, it boils down to some specific and pretty fatal flaws in what this model can see, and more importantly, what it can't see.
So here are VAR's critical blind spots. First, it's totally silent on what they call tail risks. You know, the absolute worst-case company-ending disasters. It also fails a key math test called subadditivity, which is just a fancy way of saying it has no idea how risks can pile on top of each other. And maybe the biggest thing, it thinks risk is always an outside attack, but so much cyber risk actually grows from inside a system. It's just blind to what makes cyber threats so incredibly dangerous. To put it as simply as possible, VAR is asking the completely wrong question. It gives insurance companies this comforting number, this false sense of security about their likely losses, while totally, 100% ignoring the terrifying question, just how bad could the global catastrophe actually get? And let's really visualize how the math just breaks down. In finance, if you have two separate risks, you can usually assume the combined risk is less than just adding them together. That's diversification, right? But in cyber, a phishing attack isn't separate from a ransomware attack. The phishing attack is what causes the ransomware attack. The risks don't add up, they multiply. And VAR's formula just can't handle that reality. It's not in its DNA. Okay, so we've established the problem is, well, it's pretty serious. But the good news is the paper doesn't just ring the alarm bell and run away. It actually points us towards some solutions. So let's look at the smarter tools, the ones actually designed for this kind of mess. So first up is something called tail VAR, or TVR. Now, remember how regular VAR just stops at the edge of that disastrous scenario? Well, TVR actually looks over the cliff and into the abyss. It asks, okay, if things go catastrophically wrong, what's the average loss we should expect to see inside that catastrophe? It's just a much more honest and realistic way of looking at things. And then you've got the real specialist, extreme value theory, or EVT. Now, this isn't some financial model we're trying to jury-rig. EVT is a whole field of statistics built from the ground up for one reason, to analyze and predict those 100-year storms, the exact kind of rare, world-changing events that VAR pretends don't exist. This table just lays it all out so clearly. You can see the whole story right here. VAR looks at the minimum loss and is basically useless for extreme events. TVAR is better. It looks at the average of those extreme losses. But EVT? EVT is the pro. It was designed to understand the nature of the catastrophe itself. We're going from a tool that's not very careful to one that is extremely cautious. All right, let's pull all these threads together and connect it back to that really stark warning we started with. How do we go from mismeasuring this ticking time bomb to actually managing it and maybe, just maybe, preventing a crisis? So here's what you really need to take away from all this. This is not some nerdy debate for academics. These flawed models are underwriting the policies that protect our entire global economy. Relying on VAR for cyber risk is, and I'm not exaggerating, like using a weather forecast that just ignores the existence of hurricanes. But the most important part? Better tools that can see the storm coming, are already here. They exist.
And that really leaves us with this final urgent question. The blueprint, the math, the models to properly measure this risk and prevent a crisis, it's all there. The only question left is, will the industry actually use it before that ticking time bomb goes off? Thanks for joining me for this one.